While some online bullion dealers continue to charge $4 over spot for US Mint Silver Eagles, SD Bullion is selling 2016 Silver Eagles for just $2.29 over spot for any quantity. Again, that's just $2.29 over spot for any quantity. If you haven't joined over 25,000 new customers by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us once again is our good friend up in the high hills of Denver, Dave Kranzler. It's great to have you back, Dave.
Do you mean high as in the legal marijuana sense, or high as in a mile above sea level?
Oh, both.
I meant a mile above sea level, but we'll let you take that however you interpret, Dave.
I'm doing.
We know
great.
what you're doing after the podcast.
I'm doing great. Thanks for asking. Thanks for having me on again.
All right. Well, it's been quite the week of action for gold and silver this week. Looks like they've been skiing on some of those Denver mountains. Gold made a big move Thursday. We broke through 1,300. We made about a $15 or $18 move through 1,300 up to about 1,318, and then the hammer was dropped early in morning New York time, basically right after the COMEX opened, and gold was knocked down. I think the lows were about 1278, 1279. Silver was knocked from about 1780 all the way down to right around 1710. And what was interesting is the bankers painted an outside reversal day on gold, really the same day that a new higher high was placed. So, and for those who aren't really familiar, anyone looking at technical analysis would have been waiting for confirmation of a higher high in gold to get back in the train for confirmation that we are in a new bull market. So on the same day that gold placed a new higher high, the bankers smashed it to paint the charts for a outside reversal day to the downside. But all that said, 24 hours later, gold is right back knocking on the door of 1,300 again as we trade in the access market here on Friday, $12.99 as we speak here. So what's your take on everything we've seen over the last 24 to 36 hours, Dave?
Well, first of all, I've got gold. It's the front month COMEX contract, which I think it might be August now. So I think it's the August contract. I've got it at 1301. I think my personal view is right now is that, since probably the end of February, we've had all of the open interest, commitment of trader jockeys telling us that, gold was going to have a huge washout coming, right? I mean, some guys were looking for sub 1,100 gold, and they got it slightly below 1,200 a couple weeks ago, and then it snapped right back. And then we saw what happened yesterday. As you pointed out, it was a outside reversal day to the downside. The flip side of that is my fund partner is a big technical analysis guy, and for probably at least the last 10 or 11 years, every time there's an outside reversal day to the upside, he gets really excited. And I just say, Don, these are highly manipulated markets. These technical analysis indicators pretty much don't work. So, and obviously today, gold has snapped back nicely. In fact, when I woke up, I expected to flip on the TV and see gold down another $10 or $15, and to my pleasant surprise, it had actually rallied up about $6 or $7 starting probably around 5 a.m. New York time. So I personally think we're in what I would call sort of a managed retreat mode for the guys that are trying to keep a lid on the price of gold, meaning that I just don't think they can push it down anymore. So I think what they're trying to do is contain the upside, and 1,300 is a fairly big. The round numbers are always struggles to get through, and 1,300 they've made it clear that they're going to make it a struggle to get through it. But I think I wouldn't be surprised to see it get through it within the next 2 or 3 weeks and hold and then start attacking 1400. So, and certainly the Brexit situation aside, all of the fundamental factors that drive the price of gold and silver just keep getting stronger.
Brexit is almost like an icing on the cake. I mean, yesterday, reaction as people were pricing in more odds of Brexit failing, Remain being the vote on the 23rd next week, was a contributing factor to the downward spike that we saw. But in reality, the move that we've seen in June has been going on concomitant with this whole Brexit buildup of momentum, as the polls in the last 10 some odd days have been reflecting in an increasing momentum towards the possibility of an actual Brexit. That's been kind of just, icing on the cake, an extra impetus for further bullion prices advancing. And in reality, in looking at the news front in the last couple of days and aftermath of yesterday, a whole heck of a lot of people were trying to speak to the fact that, Brexit's not going to happen, and that people were just going and getting a little bit too ahead of themselves when it comes to precious metals. At least the typical talking heads on, Bloomberg, CNBC, et cetera, that's the kind of camp in which I speak that messaging is coming from. And in reality, here we are, closing out on Friday on the high for the day, and momentum coming back. What's also interesting, too, is yesterday and even today, we saw the London PM fix seeing some strength, and it was only after the PM fix that the whole cascade crash happened, or the waterfall fall from yesterday. And that suggests that even though, the London market is largely paper, but it is a little bit more of a physical market with some offtake, and it suggests that there may be some accumulation going on out of the LBMA on a stepped-up basis that is, in fact, something that's going to give the cartel some indigestion. So that isn't technical analysis per se, but you can see footprints in the patterns of when price changes have happened in relation to what events are going on in the course of this week that suggests that there's an underlying interest that remains for further accumulation, and it includes physical buying, which is a really important thing to see, because we've seen a lot of accumulation in the ETFs and, the speculators on the COMEX going long on paper, and that's a good thing. It's supportive and whatnot, but we also need to see a lot more physical accumulation as well, too. So Brexit's going to be interesting. I think that we're probably not going to see a successful Brexit vote on the 23rd, and the murder of the MP yesterday is going to help the Remain camp on balance. Pretty fishy execution of that unfortunate soul. And she was a pro-Remain MP in the UK Parliament.
Yeah, so let's go there for a moment. I know that as we were chatting before the show, Eric and Dave, you guys both seem to feel pretty strongly that the evidence, well, I shouldn't say the evidence, the coincidence of the timing and the method that it was carried out seemed to indicate it covered up.
Yeah, I mean, it has elements that fit a pattern of a lone nut wacko doing something. It's like the John Hinckley shooting Reagan kind of model. And within time, maybe we'll be able to ferret out more information that actually points towards something more nefarious than just some wacko. At this stage, I've looked pretty closely at this and haven't seen anything that I can put my finger on that makes that case a little bit stronger and moves us in that direction. But there's elements here that fit a pattern of a classic operation like that. And the timing is very suspect as well, too. And frankly, it's important to ask these kind of questions. And the fact that the establishment and mainstream media always admonish people for even entertaining these thoughts is suspect in and of itself. I mean, this is a very fishy kind of thing that needs to be looked into. And I'm certainly going to be looking into it as the days and weeks move forward.
Here's the problem, I think, is you try to look into it, you're not going to find anything. Yeah. I mean, that pattern goes back to 9/11. The bipartisan congressional committee that was established to investigate 9/11, when they were finished, They issued a report that said, we got stonewalled everywhere we tried to probe beyond the surface of what happened. And the only conclusion we can draw is that it didn't happen the way the government is telling us it happened, So I don't think, first of all, I don't think, the modern day, I don't think there is any modern day equivalent of Woodward and Bernstein. And even if there were, I think they would get stonewalled if they really tried to dig into this.
Woodward and Bernstein and the whole Watergate affair that they covered was actually a covert op in and of itself, and that's a huge subject for another day.
I'm just throwing it out there because it means something to people in terms of. I agree.
I mean, before I was a financial analyst, I got attracted to studying the Kennedy assassination as early as 13 years old, and that basically taught me how to think, and it is possible to put together bits and pieces and connect dots to the point where you can make a case that something is definitely not as the mainstream narrative is proscribed. But it's going to take some time to do that, and who knows whether or not there's evidentiary breadcrumbs laying around that people will be able to find and pick up and put together in terms of dot connecting when it comes to this case. It's just it's too early to tell. It's barely been 24 hours. But it is fishy, and the timing is certainly beneficial to the Remain camp.
Getting back to gold a little bit in the trading action this week. In the bull market to date, we've had several occasions where big resistance levels. It took 3 taps, and on the 3rd tap, it was out and off to the races. The $1,000 level comes to mind as the most classic example, that it took 3 attempts really to clear the level, and then on the 3rd attempt, once that $1,000 level was cleared on the 3rd attempt, really for all practical purposes, it was off to the races to 1900. Didn't really pause meaningfully until then. Guys, what's your take here on gold and really the 1300, say 1308 level making a new high? You think we're going to see something similar with the 1300 level? Because we'd now be looking at the next time challenging at the 3rd tap.
Before we get into that, I have an interesting, it's an intellectual or it's an intellectual exercise question, and I don't even know why I thought of it a couple weeks ago. But where do you think, if the COMEX if there was a rule that prevented the COMEX from issuing an amount of gold contracts that was greater than 20% more than the actual amount of physical gold that is on the COMEX, where do you think the price of gold would be?
It'd be an order of magnitude higher. I mean, it's impossible to know exactly.
Well, that I know, but I mean, it's interesting to think about because.
And add in, where do you think the price of gold would be if it wasn't for the GLD and all of the money that the ETFs are siphoning off?
That's true too, because those ETFs suck up a lot of money that would otherwise go into physical. But just look at the COMEX. I mean, I haven't looked at the numbers lately, but and I'm willing to say, use registered and eligible gold. And you can't issue more than contracts in excess of 20% of the amount of physical that's completely available on the COMEX. I mean, I think the last time I looked, I think the ratio of open interest to total amount of gold was something like 500%. So whatever that number is, I mean, where would the price of gold be if they couldn't issue more than 20% above the amount of physical? I think you'd be looking at $3,000 gold, maybe even higher.
Yeah, I totally agree. I mean, basically, there's a couple ways you can approach it from an analytical point of view. The baseline is, what is the inflation-adjusted real price of gold, and then that would be pushing up way over 2,000 and closer to 3. And then
point. I didn't even think about that.
You can also, approach it from trying to reverse engineer what money flows have been dumped into ETFs and futures trading at a level that, if you reverse engineer some of those billions and try to compute that in terms of what would have theoretically been the extra bid for gold in those scenarios, then you can see 3,000-5,000 easy. I would imagine. I haven't run the numbers, but we're talking about an enormous amount of money. And unfortunately, that's kind of like a dynamic analysis too. It's not linear. I mean, it's like trying to predict the weather, because if you change certain elements, then other elements are going to change all over the friggin' place, and it would be really hard to wrap one's arms around that and try to come up with real numbers. But I mean, hey, if anybody here is listening to that and is so inclined, go for it. That would be a really interesting exercise. I think that it is determinable to some extent, but no way could anyone get it accurately. It would be just a guess, an educated guess.
So, Doc, just to circle back to your original question about, sort of a short to intermediate term outlook for the price of gold, I just pulled up it's just a weekly chart of the front month gold contract, and at first blush, gold is really set up in a bullish technical formation. It's not necessarily so that technical analysis functions in a manipulated market, but this is a long-term weekly graph, and I mean, it's really formed a nice long base since mid 2013. And if you want to look at sort of resistance levels, I mean, there's really not a lot of resistance between here and 1800. So, well, certainly, I guess you could say there's some resistance at 1600, some technical resistance. But, I mean, this is a situation where if the manipulators lose control of this thing, gold could turn into a runaway freight train to the upside pretty quickly. So, and there's actually, as I look at it, there's a downtrend line that you could kind of draw that starts in mid 2013, and the price of gold broke above that early this year. And then there's another longer term downtrend line that goes back to when gold hit 1900, and it looks like, and again I'm just eyeballing it, but it looks like it kind of intersects the y-axis right around the 1650 level. So maybe if we can get it, hold above 1300 and consolidate a little bit, we could see 1650 pretty quickly. And again, I don't want to put a time frame on it, because for 15 years of doing this sector, the manipulators never fail to amaze me at what they come up with or how well they can hold down the price of gold.
You mean you couldn't predict the capping of an MP yesterday? Yesterday morning, about 9 a.m. Eastern Time, 7 a.m. up in those hills in Denver, you weren't sipping your coffee, ready for gold to be spanked by $40?
Maybe I was too high in the hills in Denver. I don't know. I think if you came here from another planet and just saw what's happening right now, you'd have to wonder if you were high.
I want to give the listeners a quick update on the physical market of gold and silver, what we've been seeing at SD Bullion. The physical demand has continued to slow a bit, albeit we have had some large first-time customers buying especially gold. Several people brand new to the market dropping upwards of 7 figures on gold and silver bullion. So that's always promising when you're seeing new high net worth customers to the market. But overall, investment coin demand on the silver side is slowing a bit. The U.S. Mint sold only really about 500,000 Silver Eagles this week, which is only about half of their weekly allocation or production, and marks the second straight week that the Mint hasn't sold out of their entire week's production. I think our call that the Mint will be soon ending Silver Eagle allocations is coming, and probably in the next 2 to 4 weeks. We'll see. It really depends on obviously what the market does with Brexit next week and everything, but also even if things stay somewhat subdued on the physical demand, it really depends on how many coins the Mint wants to stockpile or feels like they need to stockpile. My guess on that would be somewhere between 5 and 8 million coins, but we'll see. On the 90% side, 90% silver premiums continue to decline. They dropped about another 50 cents in the wholesale market over the past week. So again, that's another indicator that there's good wholesale supply. And then finally, we can report one of the two largest refineries of silver in the country actually has dumped a couple 100,000 silver rounds onto the wholesale market due to excess production and excess capacity to kind of tighten their supplies and their inventories numbers. So it's getting worked through on the wholesale market. But I think with those three things, it's pretty clear that for right now, investment silver inventories are pretty good, pretty healthy, and it's showing up in some of the lowest premiums for retail investors that you've seen really probably in the last 5 to 10 years. So premium-wise, it's a great time with availability to make an investment, as you're not seeing 50% or 100% over spot premiums like can see on certain items when the market's really tight and there's just not enough coins and bars to go around.
What do you think, what would you make of that as far as the market intelligence value of it, given that we're seeing silver, with all of the happening all aside, we still see silver in an uptrend, and presumably there's more supply coming to the market because of these actions, and they're somewhat contradictory, and I'm wondering what you think of it.
Yeah, I mean, the gold and silver market right now, it's so small in the country and it's so cyclical that, I mean, it can change in a dime overnight like we saw last year.
Mm-hmm.
But I mean, the last month or so, demand has decreased from what it was probably Q1 and early part of Q2. So I think it's healthy and it's a good thing to get all the supplies and inventories back up. If you're a retail investor, I mean, you don't want to buy when there's a shortage. You want to buy when there's plenty of coins and you're not paying an exorbitant premium. And it's
one of the things too that might be interesting, and I'd love both of your guys' thoughts on this. I think that there is a qualitative difference in the silver market versus gold because there's a huge stacker community, and at least when it comes to United States demand and to some extent Canadian demand, the stacker community, when it fires up, it fires up. I mean, last September is a great example, August, September, and all of the buying for Silver Eagles, and I think there's something to be said, and I really, quite frankly, haven't been able to fully ferret exactly what's going on here, but when we look at the U.S. Mint and its production and what goes on in the retail supply chain and so forth, there's, to some extent, there are elements that suggest that completely different market psychology is up and running when it comes to who's consuming Silver Eagles versus who are the paper jockeys that are willing to go and buy SLV and play in the futures markets. And I'd love your guys' take on that. I mean, it's something I'm completely speculating on. I really don't have a firm idea as far as the merits of the theory, but what do you think of the theory?
Didn't I see an article a couple of weeks ago that silver maple leaf sales from the RCM hit an all-time record in the first quarter of this year?
They did.
Yeah.
And I guess because when I noticed the premiums were coming in earlier this week, so that would suggest that the supply is increasing relative to demand, right? And I'm wondering if Doc, you had alluded to, a lull in demand. I'm wondering if just the general economy is putting enough stress on the average person's income that they're not, to the extent that there is a small amount of people buying silver in this country. I wonder if it's kind of put a little bit of a damper on that. I wonder if a lot of it's just purely an economic phenomenon.
It could be part of that. I mean, if we're just purely speculating, my speculation would be as far as to the stacker community and those that are already fully convinced of where we're heading and can see the writing on the wall. They went all in last August, September, October, as far as any savings that they had. And I mean, we see that with countless customers that at this point now it's $300 a week or $300 a month that excess from their salary right now, but they're plumb out of savings.
The other thing that's interesting about that is even though we've had high premiums over the last few years, and like last summer, we had obviously that big spike up in premiums. it didn't. The price of silver and gold kept going lower, so it wasn't like the high premiums were correlated with the directional movement of gold and silver going higher. If anything,
Exactly.
they correlated with the. So I don't, there may not even really be a lot to read into this in terms of what it means for the price of gold and silver. I look at these long-term weekly graphs of gold and silver, and it's just like, wow, these look really bullish.
Yeah, and the one other thing is traditionally in the summertime, physical metal sales for investment purposes, it's the slowest period of the year, outside of last year, which is an anomaly with everything with Brexit and the markets exploding and the fear of the Shemitah and the financial collapse coming in the fall. So last year obviously was anything but that. But oftentimes it's a little bit slower in the summer as their kids are out of school and they're on vacation and they need their money for that.
What did you guys make of the FOMC decision? I mean, it may surprise you, but I actually have an opinion on that.
Well, considering the last time we were on the show, you dumped on me the forecasting. Well, we're going to do it to you. What's your opinion, Dave?
Well, I was saying from the minute the first, regional Fed clowns came out and started telling us that June was a live meeting and that they were serious about raising rates, and I threw a flag on that immediately. I'm like, they're not raising rates. And the more that I had thought about it, because I've been looking at the housing market pretty closely recently, and I'm going to start publishing on it again. Because I do think it's starting. I think it's hit a wall, and I think it's going to start heading south now. I mean, what's really been the catalyst driving auto sales and home sales, and home sales are still substantially below where they were at the peak of the big housing bubble, is record low interest rates. So I just don't see how they're going to even raise rates 25 basis points. Because most of these 3% down payment mortgages are priced so tightly to what the home buyer can afford in terms of a monthly payment that any blip in their disposable income, and they're not making the next mortgage payment. And a blip could be, higher interest rates for any of them who have taken down adjustable rate mortgages, which are now available freely. So, I just think they've painted themselves into a corner where they can't raise rates without completely pulling the rug out from underneath the economy, and I'm sure they know that.
And what's also interesting is that we're seeing a really growing appreciation for the Fed being in turmoil and really not knowing what to do. The amount of stories that are visible within the last month about loss of credibility, like 5 times what it was earlier this year. I'm not exaggerating. So it's fascinating to watch that dynamic unfold, and I think that that's also going to lead to higher gold prices, because a lot more people. It's part of what's driving the Soroses and the Druckenmillers and so forth of the world, because they can see that the end game is here, and that the powers that be no longer have the back of the stock market and the bond market. And as that unfolds, as the months proceed, I think it's going to translate into a heck of a lot more people taking an interest in precious metals.
Yeah, I completely agree with that. I think a lot more people are realizing that there's no end to the money printing.
Yeah, and that the
there's
system
no end to the credit creation, and because when it finally does sort of end, that's when everything collapses. And I think you are seeing a lot more people, a lot more very wealthy people, and larger institutional type pools of money. You mentioned a couple of the names a minute ago. I think they're starting to convert their fiat assets into physical gold and silver, and probably a few other hard asset type things.
And I have a suspicion once, whether it's the third tap or whenever it happens, once gold breaks through 1,300 with conviction and starts to run towards 1,400, I have a suspicion that is going to happen quite quickly.
Oh yeah, and I mean, I think that'll happen before the end of July, frankly, because the setup is here, and a lot of people are still in disbelief, And by the end of this year, I think targeting 1,500 is going to be pretty easy to do, like we're talking about on the last show that we were doing, Dave. So it'll be fun to see how this momentum translates into higher prices as more and more people come into the marketplace. I mean,
right. And,
the negative interest rates are like a flashing neon sign to big Wall Street and City of London money, the conventional finance world. I mean, it's like something that they can't ignore. And when the German bond slips into negative interest rate territory, it's got to send shivers down the spines of people throughout Europe managing money.
Especially since the Western Central Bank, well, really the global central bank policy has been to try and create inflation. Well, the only inflation they've created is in anything that's fueled by credit.
We've been going through credit creation since the latter part of 2008, and now we have bond yields that are lower than the 2008-2009 crisis crash. I mean, what more needs to be said? The system is broken, and more people are recognizing that, and it's so broken, and the bond yields going into negative territory, being the flashing neon sign that they are, it cannot be hidden. And that really is, I think, the capper that further undermines the perception of credibility in central bankers. And that's going to really give a huge boon to precious metals over the course of the remainder of this year. I think it's really going to be, by when we can look back in January of this next year, I think that is going to be the number one catalyst that a lot of people will be pointing towards, is just the decline in the economic situation, deterioration of confidence in central bankers, and recognition that the system is broken.
I agree.
All right. Well, Dave, we'll let you back into those hills. Let you retreat into the hills for the rest of the weekend.
Maybe I'll try and get as high as possible this weekend into the hills.
Well, hopefully shortly here it'll be gold and silver that'll be taking us high into the hills. We've been waiting a while. It's about time. All right. So we'll wrap the show on a light note there this week. So for the doc, Eric Dubin, and our good friend Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.